Alright folks, it's that time of the week again. Let's have a look how I've done, shall we? It's a pretty flat week. Slightly outperformed the three comparators. Obviously bonds did better this week since Life Strategy 60's the highest of the comparators. And yeah, there's the normal disclaimers. I'm a terrible investor, don't copy me. So let's have a look where that came from, shall we? There we go. Anything to note there? Oh, all of these ones. I guess this is related to the Bank of England lowering their interest rates, which I think was widely expected. So it always baffles me a little bit when an expected thing happens, yet the share prices are still affected. But anyway, I mean, you would have thought that would have been affected too. So yeah, not sure about that. Oh, hang on a sec. I'm pretty sure Care REIT went ex-dividend this week. That probably explains part of that at least. Oh, the banks seem to like, yeah, and yet again, this is another confounding thing. The interest rate went down, yet we're always told that banks prefer higher interest rates, aren't we? I mean, I guess it's the yield curve, isn't it, that they like? They want the longer bonds to have a higher yield than the shorter bonds. But I don't know, yeah, but we're always told higher interest rates are good for that. Yet Barclays and NatWest have both gone up. Yeah, and yet nothing else to note here. There isn't any other things happening on that front. Okay, and then we'll look at Fundsmith. Oh, hang on a sec. I seem to have messed up this spreadsheet. I must have at some point gone to hide the column and accidentally deleted the column. Okay, I've managed to restore last night's version of this spreadsheet. There wasn't too many changes. I've never done that before. It's pretty nifty actually. It kind of tells you what's changed as well. So I knew what I had to do to get it back, to make sure I'd updated it. I had to just add the MasterCard dividend in there. Yeah, so anyway, let's have a look how this one's done. I remember Google doing awfully, and Amazon's done bad as well. Oh, Fortinet is on another run, up 6.72%. So I'm guessing CrowdStrike might be similar. Yeah, another 5.91% for CrowdStrike. Them two are really going at it. I don't know. It makes me nervous. I expect them to come down from their highs at some point. Meta, yeah, Meta has for a long time now been doing ridiculously well. It's way above Microsoft. All right, well, anyway, that's that. Dividends were pretty sparse. Just F&C's got the first dividend from F&C there, which is good. I presume I've put it in here. I just had this sinking feeling that I hadn't put it in here. Yes, I have put it in there. Okay, great. Yeah, so £66.73. All right, and then let's go to transactions first. So as usual, on the first of the month, Fundsmith updates us, and they told us that they had sold Pepsico, and they have initiated a new position, which they will tell us about once they've reached the weighting they want. Because they've started a new position, and because I was feeling lazy on the 3rd, whenever it was, instead of distributing all of the Pepsico cash to the whole of the portfolio, I decided just to put it into VUSA. Just because we know there's going to be another purchase soon, and I just couldn't be bothered. Apathy's starting to set in here. And then the other thing is, I've quite fancied FICO, which is Fair Isaac, I think they're called. FICO is the ticker, the kind of like a ratings agency for loans. And that's another one that Joseph Carlson has been talking about, possibly getting closer to a price he'd pay for it. So yeah, I'll either go, that money there that's in VUSA is kind of a placeholder. So that money will either go into FICO, even when Joseph Carlson buys that, or it will go into the new Fundsmith holding, even when he tells us about it. So yeah, I just figured, since I know there's going to be a new holding at some point, I might as well just save the time, save the spread as well, and the 0.3% round trip on the currencies, and just go into VUSA for the time being. So as you can see, there it is. Okay, so then there was the RNSs, and GSK had their annual result. Was it an annual result, or was it a quarterly one? I think it was annual. Yeah, final results. Yeah, so basically just a load of stuff that I don't particularly understand. I think I've got a vague memory of it being similar last time, where the vaccines did badly, but it was made up for by the other areas of the company's portfolio. So yeah, pretty similar story, but I mean this week, as we can see on my performance here, it jumped up by 6.47%. But I mean, yeah, I mean the whole week it's up 2.7%, which is, you know, nothing majorly special for a week. Oh, I mean the most important thing is the dividend. The target is now going to be, 16p is the last one that's getting paid, and then their target for next year is 64p in total, which is 4 times 16. So yeah, that's pretty good. So next year's is going to be up 4.9%, which is pretty good for a 4% yielder, 4.44% yielder. All right, so that's GSK. And then this was the big news that hit yesterday. It's kind of annoying me, to be honest. I would not like this to happen because it's not what I want. They're proposing they combine with JGGI. And, you know, when they say combine, it's kind of a euphemism for we're going to get taken over. Yeah, there's talk of this being instigated because Sabre, I still don't know how you say it, Sabre or Sabre, it's definitely not Sabre. There's no R there.
We'd love to put this on the Sabre website.
Sabre.
Oh, it's Sabre.
Yes.
Of course.
This is gonna be a good day for Dunder Mifflin and Sabre.
Sabre.
Dunder Mifflin is a part of Sabre.
You sure it's Sabre?
They reckon it's because of that. It's that whole thing with the 7 trusts. They reckon they reckon that Henderson International think they may be next. So it feels like this is like a preemptive strike. Let's just get out of this before we have that drama with Sabre or Sabre. It's annoying for me because this isn't what I want from an investment. I covered it in the previous video, didn't I? You know, obviously it's a good trust. It's just not suitable for me, I don't think. So yeah, I've got a bit of a dilemma, but you know, things won't happen until July, I think, or something like that. So I've got plenty of time to mull it over and have a think about what I'm going to do. It's quite annoying because obviously all I've got is these 3 trusts, which make up about 30% of my portfolio, 27%, that are income, smooth out the income that they pay you, but they're income focused trusts that pay out a growing dividend, and they're kind of committed to growing it every single year. So it's kind of and have it covered by, or at least have it covered by the underlying portfolio's dividends eventually. Like Henderson International chose to go a bit growthier, but in time plan to have it covered, for instance. But like obviously JGGI, as I mentioned in that previous video, it's just like a 4% of the NAV at a certain point in the year. I think, yeah. So it's a whole different philosophy, and to me, it's not. It goes into this sector, investment trust. It goes into global equity income there. But if you go through this list, there is not. I'm not sure about that one, but any of the ones that have a decent yield, I looked into them. Hardly any of them actually invest in a high dividend portfolio. Invesco, that's another one that pays some sort of NAV related percentage. I can't remember exactly what it is. I think they're all the same. I've looked at this list before and none of them are suitable. I mean, I think this one, I can't remember, to be honest. It was a while ago, but none of them are suitable from memory. Either because they are too low a yield, or they just go for this NAV thing, which results in bad times, which haven't happened for a long time, will result in time with reductions in the income. I mean those reductions could have come after lots of massive rises, because obviously JGGI has done very well. That's why its 5-year growth rate in its dividend is 8% compared to Scottish American's 4% and Henderson International's 6%. But yes, that's the whole point. It's volatile, you know. It'll go up faster in good times. It'll go down in bad times. Whereas these will be a bit more tempered, you know. And that's kind of what I want. That's what I'm looking for. Be it, you know, be it for better or worse, you know. It's been worse recently, but as we can see by the total return here versus here for Murray International and Henderson International. Yeah, to me it's just a question of choice, you know. It's not that the thing it's going into is bad. Obviously it's really good, it's just not suitable to me. It's not what I want. So a bit of a dilemma. I am not quite sure what I'm going to do, but I was thinking about, like, because the only ones that are suitable I already own, Murray International and Scottish American. I already own those two. And I'm not sure I'd want any one trust to be much more than 10%. And as you can see, one's over 10% and one's at 9% already. So yeah, I'm not quite sure what I'm going to do. I'm thinking, at the very least, I'll probably just equalise the Murray International and Scottish American. Obviously, I'll wait until the actual merger happens, purely because this is part of the reason it's happening, is that if we look at Henderson International, even today, it's, well, obviously the numbers haven't updated because that premium and discount, to me, that's from a few days ago. Because if we look at their estimated NAV, it's about 189. If we do 183 divided by 189, the discount has now gone to about 3.2% compared to 11.07%. That's why the share price jumped by 7% this week. It's just reduced the discount, and that's why. It's because JGGI pretty close, and I think if you look at the history, it's been slightly above zero for most of the time. Obviously had a bit of a dip there, but yeah, that's part of the reason for the merger, and that's part of the reason why the share price jumped, is because they expect that when the merger happens, the new shares of JGGI will be at this similar premium rather than being at a discount. So yeah, I mean, that's a bit disappointing that Hargreaves Lansdown website is so slow to update. It still says 11%. Pretty poor form, that, I think, from Hargreaves Lansdown. Mind you, at the moment I'm not paying them a penny for this website because I'm not a customer anymore, so I can't complain too much, can I? Yeah, because it says here that they kind of match up the NAVs. They have got a different term for it. I think it's obviously a bit more complicated than just matching up the NAVs. Oh, here we go. FAV. What does that stand for? The F. Formula asset value. So it's obviously some sort of adjusted asset value that takes other things into account rather than just the NAV per share. So I think obviously this is some sort of thing that makes it fair. Obviously I don't understand it thoroughly, but it should result in just getting a JGGI share that's equivalent to, in value, to what you already own. In terms of the NAV, that's why the discount has come in, not in terms of the share price. So they're not matching up the share price, they're matching up the NAV, and that's why it's good in the short term, at least for Henderson International owners, because the discount comes in. But yeah, some things annoyed me in what they wrote here. Yeah, that's all fine. Improved share rating. Yeah, I mean, that's what I just said. Share rating. It's at a premium for JGGI, and hints at about 10% discount when they wrote this. Scale, yeah, that's good because obviously it's a bigger one, so the liquidity is better. Yeah, this one annoyed me. Consistent dividends. I mean, they've literally said a lie here, because they've said consistent dividends, and then literally in the next sentence they've told us why it's not going to be consistent forever. It's 4% of NAV per year. It baffles me that they are so delusional that they'll just spout out nonsense and then literally in the next sentence contradict themselves. When markets go down, which hasn't happened properly for like an elongated period of time, hasn't happened since like 2007, not for like a long time, that would affect this, because even the COVID drop, if we look at the history of the dividend for JGGI, I've got a feeling the drop we had for COVID didn't last long enough to actually affect the dividend. I think it recovered in time for the dividend to still go up. This might not cover it actually. Let's go further back. Yeah, so we can see there the drop we had for COVID, which only lasted a few months, I think, from memory. If we go to JGGI's chart, I think we have to go back even further than 5 years now, don't we? I think that's just as it's starting to drop there at the beginning. So the COVID drop here went down by 25%, 27% roughly. I think it's hard to get the cursor right. So yeah, but in the ballpark of 27%. So obviously that was quick enough. Whatever date they use to decide what the dividend's going to be, it obviously had long enough to recover before they determine the new dividend. So that hasn't happened yet, such that this dividend policy has had a reduction in the dividend. And I'm guessing that if we go back to 2007, I'm guessing the dividend policy was different back then. I can only assume. I mean, look, it's pretty volatile anyway. Whatever the policy was back then, maybe they just didn't have a dividend policy. Maybe it was just literally pay whatever we have to be an investment company. But you can see there, and it was once a year as well. So yeah, I don't know what the dividend policy was then. But anyway, since they've had this 4% of NAV thing, they haven't had a proper bear market that's lasted long enough. But I imagine if that was the policy here, if we had a 4% policy here, it's a bit annoying because I wish I could. We can see there that drop lasted a couple of years. So I don't know at what point they would have determined the new dividend in these times. Maybe it would only be a few percent lower, maybe 13% lower, I don't know. But yeah, it would have taken a few years before that dividend got back to where it started, if that was the policy in this time. So yeah, using the word consistent dividend to describe this is just using recency bias. I expect more from these people who are supposed to know about this stuff. I mean, they're just promising things they can't see through on. I am in two minds. I was thinking I might just kind of, like I do with Fundsmith, I was thinking maybe I'll just take some of the higher yielders from the likes of, there's these global trusts. If we just go to the global trust section, so obviously there's these ones which are kind of all weather, all of market stuff, pretty low yield. Well, these ones that kind of yield about 2%. Obviously those trusts are kind of style agnostic. They'll have some value stocks that pay a decent dividend. They'll have some that are high growth that pay no dividend. So I was thinking maybe I could do some sort of Fundsmith thing where I take the higher yielding picks from a few of these that I don't own. I mean, maybe bankers, because that's Janus Henderson run. Maybe if I just pick the higher yielders from the top 20 or something like that, and I can build myself a little portfolio or a pie in Trading 212 of the higher yielders that at least should grow longer term. So it's kind of doing it myself in the same, just kind of copying people though, copying these trusts. But that could be a bit labour intensive doing that, so I'm not so sure I like that idea. I did have a little look around for ETFs that are kind of global dividend ones. I filled into the data. This is the obvious one, VHYL from Vanguard High Yield, I think it's called, something or other. That's quite a common one. But if you look at the dividend history there, it's just no good. And I'm not into it going down by 20% because I have excluded a partial year here for 2012, I think, 13. I've excluded a partial year, so that is a full year's dividend. So it started off higher than it was in year 2. And then it's got 2 years of going down a bit here, and it's going down there. Not growthy enough. It's gone from 1.97 to 2.09 in about over 10 years. I don't like it. I'd rather just build my own portfolio and then I can see how the dividends are changing myself. That's no good. There was this other one I saw from Spider. I think it was SPDR. A lot of these dividend ones are really low yielders as well, nowhere near high enough. I think SPDR had a pretty close yield because the obviously now the bar's lower because the share price had quite a nice bump, and then eventually there'll be a bit more of a bump because it's still at a discount. This yield might go down to about 4%, who knows, something like that. It depends how it is at the end. So yeah, the bar's lower now to hurdle over. This one had about, as far as I could tell, about a 3.9% yield, close enough. But again, the charges are quite high for an ETF, 0.45%. And I looked at the dividend history, it's so erratic. It's just not suitable at all for someone who's retiring and wanting to live off them. I might just throw the towel in. I might As I mentioned earlier, I'll probably top that up to be about the same as Scottish American. So a few grand will go in there. And I'm thinking SCHD, I could put a few grand in. And maybe I'll just put 20 grand into a combination of JGGI, let the dividend come in, and then maybe put 10% of it, I'm thinking. Because if say if we go for like a doomsday scenario and the NAV drops by 50%, say, like some sort of dot-com bubble or great financial crisis sort of situation, and it halves, and it takes 5 years to get back to where it was. If I have 10% VAGS, so it's like global aggregate bond fund, it's kind of VAGS, and I could just kind of turn it into an 80-10 portfolio, I guess. So it's not, obviously you wouldn't do that with your whole portfolio because that would be too volatile, but because this is just like a small percentage of my portfolio, I'm thinking 10% in bonds, 90% in JGGI, and I can just kind of half look at it as like a total return thing, and then just when the NAV goes down and the dividend follows it down, maybe I can just eat into the aggregate bond fund that's here instead, and I can do it in trading 212 as a pie. So I can do something like this. I can create myself a pie, custom, add instrument, JGGI. That's what I need to click. So I can add that to pie. I presume I click back there. It's been a while since I did this. So I can do something like this. VAGS, add to pie. I think I click there, don't I? And then I can just do 90% in JGGI, 10% in VAGS. And then when I see that the dividend is coming in lower because the NAV's gone lower, I can just top it up with selling this one. And obviously that will reduce my long-term returns because we've got a so there we go, maybe something like that. And then obviously by doing that, basically what you're doing is if the fund NAV goes in half, what you've essentially got to do there is top up your dividend by 2% of JGGI's value. So obviously 10% divided by 2% gives you 5 years before the recovery happens. So what I would do in that scenario is I wouldn't increase the dividend that I get from this pie. I would just keep it flat until JGGI is high enough. Well, obviously it needs to get high enough, taking into account the rebalances that I'll do every now and again, because obviously you need to keep VAGS as 10% of this pie. Otherwise your number of years you've got in bonds goes down. So obviously whenever this pie tells me that it's unbalanced by a certain amount, I'll just rebalance it. So obviously that's going to, in good times, reduce the amount, the number of shares I have in JGGI. So that would reduce the dividend it pays me. But in the good times, the dividend should grow hopefully faster than the rebalancing takes it away, if you see what I mean. The dividend per share will go up faster than I'm taking shares away to rebalance into the bond fund. Yeah, so that's one thing I could do, but I mean that's just, it's the thought of like abandoning the whole value aspect of it just when it, who knows when it's going to turn around, or if it, I mean it probably won't ever turn around, and this might be the best option, just keeping most of it in JGGI, but adding a bit of low volatility stuff for the bad times, and just kind of keeping it rather than doing this over your whole portfolio, because this is essentially the plan there where I did that video, the 75%, 25%, what could have been plan, but it's kind of it's kept as just a small part of the portfolio. Obviously that would require me transferring the JGGI holding from iWeb to Trading 212, because currently all of Hint is in the iWeb ISA. I'll obviously be voting against this if there is a vote. Is there even a vote? I mean, the word vote doesn't appear in this whole thing. I don't know what that sentence means, to be honest. They want a meeting, but there's no mention of what the meeting is for exactly. I mean, are they implying that that's where we vote for it or against it? I'm not sure. I mean, chances are they'll have locked up the vote anyway. They've probably spoken to all the big shareholders anyway. And it probably wouldn't make any difference even if there was a vote. It's probably just going to happen regardless. Okay, anything else? I don't think so. Yeah, that's it. I'm sure I ranted on and on and on there because I have a lot to think about. So, alright, I think that's it then. People, let's go. I almost said fellas there, which, if I was going to guess, how many subscribers do I have? I think I've got 320 subscribers. I would not be surprised if 100% of those subscribers are male. Have fun. Bye.